If you're trying to invest right now, you probably feel like you're getting tossed around in a washing machine. One day the market is up, the next day it's down, and the headlines just seem designed to confuse you. But what if there was a way to see through all that chaos? What if, underneath all that surface noise, there's a hidden structure, an unseen map that shows you the true direction of the market? Well, today we're going to uncover that map, specifically for gold and silver, using a tool that teaches us to ignore the headlines and focus on what the market is really trying to tell us.
I mean, let's be honest. It's a complete mess of contradictions out there. You've got geopolitical tensions flaring up, you've stubborn inflation here at home, and one analyst tells you, this is it, this is perfect for gold. And then the very next day, gold and silver sell off hard, and you're left scratching your head, wondering what on earth is actually in charge. It's the classic trap for investors, a constant scramble for clarity in a hurricane of information overload.
So, how do we find a path through all this? Here's our game plan. First, we're going to ask if there's even a real signal we can trust in all this noise. Then we'll look at what's called the headline trap and why reacting to the news can just be brutal for your portfolio. After that, we'll introduce a totally different way of seeing things to uncover the market's hidden structure. That leads us to what our source material calls the market's true map. Then we'll connect that technical picture to a huge real-world driver: panicked central banks. And finally, we'll look at the explosive move that this analysis predicts is coming in a section we're calling the coming price tantrum. Okay, so where do we even begin to find that signal? Well, the very first step is to start questioning the stories we hear on TV every single day, the popular narratives about what's supposed to be moving gold and silver, because it turns out a lot of them just aren't true.
This is a big one. This quote right here challenges a core belief for so many investors. The source material from analyst Michael Oliver is crystal clear on this. The idea that geopolitical conflict is automatically good for gold in the long run is basically a myth. The historical correlation just isn't there. You know, these events create huge short-term spikes in volatility, for sure, but they are not the engine that drives the main multi-year trend. They're a distraction, not the destination.
And that leads us to the billion-dollar question, doesn't it? If the day-to-day drama of geopolitics and news is just a smokescreen, then what's the real fire? What is that invisible force that's actually pushing gold and silver over years, not just a few days or weeks? Well, to answer that, we first have to understand just how dangerous that smokescreen can be.
And that brings us to the headline trap. You know, the source uses a fantastic, if kind of brutal word, for what happens to investors who trade the news. They get skewered. It's painful, but it's a perfect description of chasing these stories that are more often than not just noise designed to get you to react emotionally, and usually incorrectly.
This timeline is such a perfect example. So the market's already looking a little shaky. Then boom, a surprise tariff announcement. The market tanks. Now imagine you're the person who saw that headline and sold everything. For a week or two, you feel like a genius. But then, a couple months later, a 90-day pause is announced. The market absolutely rips higher. And now, not only did you miss that whole rally, you're forced to buy back in at even higher prices. You got skewered. The folks who just ignored the noise, they're the ones who won.
So, here's the bottom line. Reacting to headlines is a trap. Whether it's tariff news or geopolitical news, it's all designed to cause these sharp emotional moves that feel incredibly important in the moment, but they're usually just masking the real underlying trend. If you're making your decisions based on breaking news alerts, you are staring at the wrong dashboard. You need a completely different set of gauges.
So this is where things get really interesting. If price action driven by the news is the wrong signal, what's the right one? The source material puts forth this really unique method, developed over 40 years, called Momentum Structural Analysis, or MSA, and it requires a huge shift in what you're actually looking at on a chart. Okay, so MSA basically flips conventional charting on its head. While almost everyone else is obsessed with the daily up and down price wiggles, MSA studies the structure of a market's momentum. Think of it like measuring the trend of the trend. It's not just about how fast things are moving, it's about finding consistent patterns and levels within that rate of change. And this approach can spot major trend changes months before they show up on a normal price chart.
And this just illustrates the difference perfectly. Imagine you're driving a car in a really thick fog. Price analysis is like your speedometer. It tells you your speed right now, where you are, which, isn't that helpful. But momentum analysis, that's like having an accelerometer. It tells you if you're speeding up or slowing down. It reveals your trajectory. It tells you where you're going. It lets you feel if you're accelerating toward a cliff long before you can see it. Price is just noise. Momentum reveals the clear underlying structure that the fog of news totally hides.
All right, so theory is great, but let's actually see how this works in the real world. We're about to look at what the source calls the market's true map. And I'm telling you, this might change the way you look at charts forever. This is a real aha moment.
First up, here's a standard price chart of the S&P 500. It's a confusing mess, isn't it? Just chopping sideways, up, and down. The source calls this a topping process. And if you're only looking at price, it's pretty much impossible to tell what's going to happen next. Is it going up, down? Who knows?
But now, look what happens when we switch to the MSA chart for that same exact period. While the price chart was total chaos, the momentum chart shows something incredibly clear. It's a solid, horizontal floor of support that's been holding for years. And here is the really critical part. The S&P's momentum is now breaking below that multi-year support line. That 6424 number isn't random. It's a huge line in the sand. A break like this is like a major crack appearing in the foundation of the entire market. The engine is starting to fail, even if the car is still kind of coasting along.
Now let's use that same logic for precious metals. If you look at a simple price chart of gold and silver versus the S&P 500, well, it's a decade of pure boredom. For over 10 years, they've gone nowhere compared to stocks. From a price point of view, it looks like a dead asset class.
But when you look at the momentum of that same relationship, a totally different story appears. Instead of a boring, flat chart, you see that a massive 10-year base of momentum has just broken out to the upside. In chart terms, a decade-long base is like a colossal amount of energy being stored up. That breakout is like a giant coiled spring that's finally been let go. This isn't just a small blip. This is a huge structural break that signals a powerful, multi-year shift where metals are now set to dramatically outperform stocks.
Now, a technical signal that strong, one that's been building for that long, doesn't just happen in a vacuum. It needs an equally powerful, real-world driver. So what's the reason? What's fueling this huge structural shift? Well, the answer usually comes down to the predictable behavior of central banks.
The ultimate, bedrock reason for all of this is what's called monetary debasement. If you ever want to know the true long-term case for gold, forget all the daily headlines and just look at a chart of the M2 money supply. It's a parabolic curve going back decades. It represents nonstop currency creation. Every time a new dollar is printed, the ones you have in your bank account lose a tiny bit of their buying power. Gold is just a defense against that slow, quiet theft of your wealth.
And this leads to a cycle we've seen play out over and over again. We saw it in 2000, we saw it in 2008. First, the stock market bubble, which was inflated by all that cheap money, finally pops. Then, the bad economic news starts rolling in, and in response, the central banks, as the source puts it, go berserk. Their only tool is the printing press, so they print, print, print. But that new money doesn't go back into the old bubble. It flees to the safety of hard assets like gold and silver.
So what's the likely trigger for the next round of this? The financial sector. The source material calls the financials the big time bomb issue. This isn't about just one bank having a bad quarter. It's about a systemic weakness that's been building for years. And the momentum charts are picking up on this weakness long before it becomes a front-page crisis. When that fragility finally cracks, when the beast breaks, that's the moment you can expect the Fed to panic and unleash the monetary fire hoses all over again. So, we've seen the trap. We've uncovered the hidden map of momentum, and we've connected it to the very real driver of central bank policy. Now, let's look at the final piece. What this all predicts is coming next for gold and, more importantly, for silver.
All right, so based on this analysis, the source material projects a price target for silver somewhere between $300 and $500 an ounce. Now, I know, with silver where it is today, that sounds absolutely insane, but the most important part isn't just the number, it's the character of the move. It's not supposed to be a slow, steady grind up. It's expected to be a fast, violent, explosive move, a price tantrum. Why? Because the market's been held down for so long that when it finally breaks free, the buying pressure is just going to be immense. It'll be like a dam breaking.
And the timeline here is pretty quick, potentially unfolding over the next several quarters. So what about that recent gut-wrenching drop we saw? Well, according to this analysis, that scary correction was actually a healthy and necessary event. It's what's called a midpoint cleansing. It shakes out all the nervous investors, the weak hands, before the really big part of the move begins. It's the market getting rid of the tourists before the real journey starts.
And that leaves us with one final and I think really crucial question.
In a world that is just saturated with distracting headlines and volatile price swings, it is so easy to get lost in the noise. So I'll ask you, what are you watching? Are you watching the temporary emotional ups and downs of price, or are you watching the powerful unfolding story of the market's long-term structure? Because right now, that structure is telling us that a major historic shift is already well underway.